Welcome back, everyone. Next, we have Forum Energy Technologies, or FET. It trades on the New York Stock Exchange under the symbol FET. It's a global company serving the oil, natural gas, industrial, and renewable energy industries. FET provides value-added solutions that increase the safety and efficiency of energy exploration and production. They are an environmentally and socially responsible company headquartered in Houston, Texas, with manufacturing, distribution, and service facilities strategically located throughout the world. Please welcome President, CEO, and Director Neal Lux and CFO Lyle Williams. Welcome, gentlemen. How are you today?
Doing great. Good morning. Good afternoon.
Wonderful. Okay, gentlemen, the floor is yours, and call me back when you're ready for questions.
All right. Thank you, Anna. Good morning, everyone. So over the next 20 minutes or so, myself and Lyle Williams, our CFO, are going to present the FET story, and we have a great story to tell. Before jumping in, again, we have our forward-looking and non-GAAP reconciliation caution slides. I'll pause here for a second. Please be aware. All right, so with that, let's get started with the overview of FET. At FET, we don't drill the holes, but we sell critical capital equipment to industry leaders that do. We don't stimulate wells, but we manufacture consumable products that enable the world's largest service companies to do so. And we don't produce the hydrocarbons, but we engineer and deliver processing and pressure control equipment for our blue chip customers to produce oil and gas. We make it happen by manufacturing value-added products and solutions that increase the safety and efficiency of energy production. We are a global manufacturer. Almost all of our revenue is derived from selling new products and solutions, along with aftermarket parts and service. We have a wide range of differentiated products in our portfolio, and our deep industry knowledge base allows us to develop new solutions for our customers and separate FET from our competition. We make it happen in the United States, and as you will see around the world. At FET, we have an extensive global reach. We have many sites located around the world, but our largest manufacturing locations are in the United States, Canada, United Kingdom, Germany, and Saudi Arabia. However, we ship our products around the world, everywhere in blue. Our products and solutions go wherever energy is produced. Around 40% of our sales this year were outside the United States. However, during previous global investment cycles, that percentage approached 50%. So to meet growing global demand around the world, to provide our products to where they're needed, we do not need to expand our roofline or invest in additional capital for growth. We just put our products on a vessel and deliver. We can service the world with our strategic manufacturing and service hubs that are already in place today. So this is a great feature of FET's business model: global reach with capital-light scalability. This is what drives our strong revenue to free cash flow. So stepping back and looking at a summary of our financials from the trailing 12 months a year ago, revenue was just under $660 million, adjusted EBITDA at $46 million, and we had negative free cash flow. Since then, we've grown revenue 13%, increased adjusted EBITDA by 47%, and expanded our margins by 210 basis points, all while growing operating free cash flow by $52 million. And this is before our exciting acquisition, which we'll talk about shortly. So the business we have in place today, with an increase in market activity, will generate strong free cash flow. We have established a great platform for the future. So as you're sitting there today thinking, why FET? Why is FET a great company and better investment? There's a couple reasons. First, the world needs energy. Energy is a fundamental building block of economic growth, and this demand will propel strong global investment in energy production. Our blue chip customer base, the world's largest oil and gas and service companies, will look to FET to provide the tools to safely and efficiently produce the energy. This will drive revenue, and that'll drive revenue growth. Our products and solutions, again, are critical, and demand for them will grow with higher capital spend. And the combination of our operating leverage, the capacity and roofline we have in place, and our global footprint will drive margin expansion. Over time, for every $100 increase in revenue, $30 to $40 will drop down to our bottom line. We have very strong incremental margins. And with our capital-light business model, we will convert a significant percentage of incremental EBITDA into free cash flow. Finally, over the past few years, we have significantly reduced our leverage ratio. And with our low capital intensity, we will remain disciplined going forward. This is FET at a high level. Let's dive a little deeper into our story with global investment.
As Neal mentioned, the world needs more energy. Global investment in oil and gas exploration and production has, for nearly a decade, been far below spending levels seen from 2011 to 2014. As a direct result, industry activity has been muted since 2015. The green line illustrates the average global drilling rig count. This measure of industry activity has been roughly half of the level during the previous industry spending supercycle. During that last supercycle, FET reached peak revenue run rate of over $1.8 billion and EBITDA of over $350 million of adjusted EBITDA. As we look ahead, the International Energy Agency and several other industry analysts predict that a 30% increase in the level of spending on exploration and production will be required in order to balance global energy markets. Looking ahead, this is a positive driver for FET. Let me share a little bit more about what activity means and what the drivers are for FET revenue. Starting first, FET revenue is highly correlated with global industry activity and spending. As you can see in the chart below, the green line represents industry activity or global rig count, blue bars being FET trailing revenue over the last several years. The chart highlights the very tight and strong correlation between FET revenue and industry activity. The previous slide did highlight the view of industry analysts who expect E&P spending and activity to increase meaningfully in the future. Second driver for us is oilfield services capital expenditures. As Neal mentioned, our customers include the world's largest service providers to the oil and gas industry. As activity levels rise, these companies will be required to make incremental capital investment to support higher activity. Such a capital build cycle occurred last in 2018 and 2019. Shipments of equipment that we manufacture pushed our revenues in these years up above the rig count curve. As today we look across our industry and the assets that are deployed by our customers, we anticipate that a meaningful increase in activity will only be possible with a significant incremental capital investment by our customers. Third driver for us is service intensity. This, in short, is the rate at which spending has to increase to achieve a given rate of incremental oil and gas production. For the past several years, the world has benefited from relatively cheap and easy to produce incremental barrels of oil produced in the United States. As the cheapest of these assets has now been exploited, we are seeing incremental investment occurring in areas of the world that require higher levels of spending, such as in the offshore and international markets. In summary, we believe that the market conditions are set up for another strong investment cycle with increasing global activity, larger oilfield service capital investment, and rising service intensity, all of which will drive FET. At FET, we have the infrastructure in place to support revenue growth today from current levels without any meaningful capital expenditure. And given the operating leverage that's inherent in our operations, we expect incremental EBITDA margins of 25% to 40% as revenues increase. Revenue growth for us, therefore, means strong incremental profitability and cash flow. In addition to these organic drivers, FET has a long history of acquisitive growth, having completed many acquisitions. Let me talk briefly about our acquisition of Variperm Energy Services that we announced in November. We agreed to acquire Variperm for $150 million of cash and 2 million shares of FET stock. Thinking about the rationale, this deal is going to be highly accretive to our financial metrics, allow us to maintain our strong and healthy balance sheet. It will add differentiated technology in niche markets and increase production-driven and international demand by our customers. Variperm is a Canadian-based company with primary revenues in thermal oil sands markets. The company's operated since 1969. It protects its intellectual property with over 16 patents and has installed over its life near over 25,000 of its products. Financially, Variperm is a very strong company with over 40% EBITDA margins and an 81% conversion of EBITDA to free cash flow. We expect to close the transaction in early January following Canadian regulatory review and typical closing conditions.
So one of the reasons we are so excited about the acquisition of Variperm is the accretion the combination delivers. The table that we have here is one we showed earlier, summary of FET's trailing 12 financial results. With the addition of Variperm, the revenue of the combined companies increases to just under $875 million, an increase of 17%, and adjusted EBITDA grows 77% to $121 million. And adjusted EBITDA margin grows to 470 basis points, a massive improvement. Operating free cash flow nearly triples, and free cash flow is up 84%. This leads to a meaningful increase in per share metrics while maintaining a conservative net leverage ratio of 1.9 times. We also have plans to further reduce that ratio by the end of 2024 to just over 1 times. The financial performance of the combined companies is incredibly strong and makes a meaningful impact to our scale and profitability. In addition to building a great company here at FET, we do want to increase our attractiveness to investors. And one way to do so is to increase our scale versus our peers. So this chart we're showing here compares adjusted EBITDA of FET and then FET plus Variperm. So FET in the light blue at $68 million and FET plus Variperm in the dark blue column at $121 versus our peers. Obviously, we moved to the right with that 77% improvement. Another way to look at our value and attractiveness is our margin. When comparing our adjusted margin versus our peers, again, FET alone in the light blue at 9%, growing to about 500 basis point improvement to 14% in the darker blue column. Again, significantly moved to the right and elevate ourselves amongst our peers. This acquisition does transform our profitability and margin and provides meaningful scale while improving our investment profile. So why FET? In summary, the world needs energy. Our blue chip customer base will provide it with FET's products and solutions. This will drive our revenue growth, expand our margins, deliver free cash flow, and ultimately unlock unrealized shareholder value. The pieces are in place for a great run, and I am confident the employees of FET will deliver. So that's the end of our presentation, and Anna, we'll hand it back to you for Q&A. Thank you.
Thank you, gentlemen. Yes, we do have some questions. I want to start with the recently announced acquisition. How comfortable are you with the integration and execution of the combined companies?
Yeah, great question. So I think as Lyle had mentioned in part of his remarks, our company has extensive experience in acquisitions. We are, what makes our company up today is approximately 40 acquisitions since our inception. We've done large ones, we've done small ones. And I think if you look at what we've done over the last 12 years, the key acquisitions that we've completed have made a significant impact to the company and deliver a strong portion of our profitability today. And I think a key aspect of this acquisition in particular is we're going to retain the team that's in place, that's been successful, and that's delivered strong growth. So I think we feel confident based on our experience that we can integrate, and we really love that team and we want to keep that team in place, and they've agreed to remain with us as well.
And what are your plans for using the cash from the strong free cash flow generation?
Yeah, Lyle, why don't you take that one?
Sure. Thanks, Anna. That's another great question. You've done a great job at FET in managing our balance sheet. Obviously, the strong free cash flow going forward would be a real positive. If we look back over time, we've delevered our balance sheet considerably, reducing our absolute level of debt from over $400 million just a few years ago to now just over about $150 million worth of total debt outstanding today. So we believe that there's real opportunity now for us to look at that cash, ultimately be able to return some of that free cash flow back to shareholders in the form of share buybacks or the like. I think in the near term, what we will be looking to do is, as Neal mentioned, reduce our net leverage from the 1.9 times we expect at closing to somewhere just north of 1 times going forward. So that'll be using free cash flow to retire the debt on our balance sheet, which will all be prepayable debt at this point, and debt that we can retire, and then ultimately look forward to using free cash flow as a means to take advantage of our share prices and unlock some of the value that we see in them, as Neal mentioned.
Thank you for that. I have a few financial questions from Eric Carlson. Starting with this, net debt post-transaction close is not materially higher than what you entered in 2023. Yet EBITDA will have more than doubled. So what opportunities are opening up for an LT debt solution that maximizes flexibility for your current cash and significant amount of expected FCF?
I think that's great. Yeah, I think that's a great question, Eric. Thank you for that. I think a bit of the points that I just highlighted there, I might want to reiterate. But again, as we look at the opportunity and to repeat what we've done in the past, significant delevering of our balance sheet puts us in position to complete the Variperm acquisition. Now incremental cash flow, we can drive down the debt that's on our balance sheet and be in position to return cash back to shareholders. Clearly, from an inorganic growth perspective, other acquisitions, there's a ripe opportunity in the marketplace for additional acquisitions. I think we would look at that in addition to cash return back to shareholders.
I would also say, just thinking about where we're at today, that if we're, roughly, between $5 and $6 per share of free cash flow, our free cash flow yield is significant today. And I think that gives us a lot of opportunities to, one, a lot of value for investors, and two, over time will give us opportunities to return cash to shareholders.
Eric also asks, do recent moves in rates open the door to reissue debt alongside the closing of the Variperm transaction in 2024?
We'll continue to monitor. I think we we'll want to be opportunistic if we see a good opportunity to refinance or to issue new debt. I think the key thing is with our acquisition, it's not required. So I think we have in place the liquidity that we need to operate the business and to close the acquisition. But we'll continue to watch rates. Again, they've had a nice decline here recently, and if we see an opportunity, we'll evaluate and again do what we've always done, make the best decision for our shareholders.
And if you could reissue long-term debt, how do you take advantage of this discount to peers?
Yeah, again, I think it's the discount shows up in many ways, and the free cash flow yield is one of them. I think returning cash to our shareholders is a great investment, and it's one we'll continue to move towards and to always evaluate.
And Tom Caldwell asks, are any of your products required for safety compliance in certain or all markets? If you can explain that.
Yeah, that's a great question. So, we address a lot of different parts of the energy value chain, and, safety is a critical component. As an example, many of our pressure pumping customers operate between 8 and 12,000 PSI. Put that in perspective, your tire pressure is about 40 PSI. So it's a huge amount of energy that you need to control and prevent leaks, and prevent damage or injury. So yeah, all of a great majority of our products, do follow a safety standard. And as we design, develop, and engineer, the safety of the field personnel that utilize our products is a key component of our design.
I would throw in just an add there is, as we look at our products, many times we work with our customers to help them take their employees out of the red zone, the hot zone. So as Neal mentioned, our pressure pumping customers are looking for ways to keep people out of the zone. We recently introduced a high pressure hose system that replaced the long-standing flow iron in the industry, taking people out of the red zone. And on the drilling side of the business, have had great success with our iron roughneck, the tool that effectively does remove employees, our customers' employees, from the hot zone and prevent injuries.
And we have a question from Don. It says, when it comes to competition, talk a little bit about that. Specifically for you, what would cause you to lose a sale? Would it pricing? Basically, how do you stay in front of those metrics?
Yeah, no, that's a great question. And part of our core strategy is to operate in market niches. So we're not offering everything to everybody in the oil and gas industry or energy industry. We find specific areas where we can compete on the value that we deliver, and our customers recognize that value over longer term. So in many of our differentiated product lines, we only have a few competitors, and what it generally comes down to is customer preference, delivery, or design. And I think where our experience is unique, we're always adding on or iterating and improving our products, and we do that by employing really industry experts who have operated our products in the field and understand how to make them better on a continuous basis. So that's our goal. That's where we're trying to apply and target, and that's been our core strategy, and it's worked well for us.
Grant Knight sees how acquisitions in your space would be beneficial. So are there any on your mind that you're looking to acquire that might lower costs, increase customer base, add technology or services?
Yeah, that's great. We're always looking. Again, our DNA, our history is based on acquisition. I think our industry is ripe for consolidation. I think both on the public and private side. We've laid out a criteria for our acquisitions. The first part is we have to have strong industrial logic. I think if you take the example of Variperm that we've mentioned here today, it fits extremely well with our existing product lines. It's complementary. It's an addition. And when we look at what they've done, they they address a key market need, and they deliver significant value for their customers. So we want to find acquisitions that have that industrial logic. We also want acquisitions that improve our margins. Again, we look back at, how do we become more attractive to investors? Scale and improving our margin base. So that's the second criteria. And then finally, we want to, again, maintain a strong and healthy balance sheet. And as we look at acquisitions, we want to be very, very careful not to put ourselves in a bad position.
Makes sense. Rob Hunt wants you to go back a little bit. You've spoken about this, but if you can go back to what your leverage is on debt EBITDA basis, what is your long-term debt EBITDA comfort level?
Why don't I take that, Neal, and you can chime in. So our expectation is to, post-closing the Variperm acquisition, be at 1.9 times net debt to EBITDA. We believe we can pull that number back down through 2024 to north of 1 times. So as we look at our historical numbers and as an industry, we've always viewed kind of 2 times net debt leverage ratio to be a comfortable ratio. I think our more recent view with recent volatility in the industry, obviously with higher interest rates, we think a lower overall long-term net leverage ratio is more appropriate. We're a business that has a lot of operating leverage in it. We talked about that as far as the incremental profit that we would gain through scale. We feel like a lower amount of financial leverage is probably more appropriate. So kind of between that 1 and 2 times would be an appropriate long-term net leverage for our business.
Yeah, absolutely.
And Eric asks, have you considered buybacks that can take a meaningful amount of shares off the market at current valuations?
We have. And as we've talked about in some of our previous earnings calls, we've looked at that. We don't have right now capacity underneath our current debt facilities to be able to return cash to shareholders through restricted payments and the like. But that's something that we would be looking towards as we're able to reduce that outstanding debt, as we talked about earlier, and free that restricted payment capacity up further.
And talk a little bit about how you participate in the energy transition and renewable markets.
Yeah, great question. So, our history has been to address the oil and gas markets as a manufacturer. So we look out and we see the needs of the industry and we develop products and solutions or buy companies that fit that. What we found with the energy transition is that many of our products have a dual use. A great example is offshore. We have offshore robotic remote operated vehicles, basically robots that operate underwater in deep water. These vehicles can be used for both oil and gas and for offshore wind. And what we've seen in recent time is that we've seen our customer base, who primarily historically had addressed oil and gas, are utilizing the same assets for offshore wind. So we've seen an increase in demand for our ROVs, or again, our robotic vehicles, for both use in oil and gas and in energy transition or new energy. Other areas we participate, another great example is carbon capture. We recently delivered a coiled line pipe steel line for a carbon capture project in Wyoming. It was one of its first of its kind, where industrial sourced CO2 was brought from a producing site in the Midwest and brought into use in oil and gas for secondary recovery. So our line was used for that final injection step. So few examples there. We also provide methane emission control and casing hardware for geothermal wells. So as we look ahead, we want to support the oil and gas industry, but we want to, again, utilize our core competencies in manufacturing, engineering, supply chain. And if investment moves off and moves into renewables or energy transition, we're well prepared to address that.
Perfect. Good way to be. Thank you, gentlemen, for your time and presentation today. Really great job. We'd love to see you in the 2024 with some updates.
Great.
Thank you, Anna.
Okay, everyone stay with us. We'll be right back with our next presentation.